Hello friends and welcome back to edupediaworld.com. Up till now, whatever topic we have done in managerial economics were all related to microeconomic issues. From now onwards, we'll be dealing with macroeconomic issues. But before starting, I would like to ask you a question. If economics is all about how to choose this much of resources to satisfy this much of consumers, then why do we have to deal with both micro and macroeconomics? The question simply relates to the scope of economics. See, microeconomics, as you have studied up till now, and you must have understood up till now, that it deals with choice of single entity, one product, one price, one consumer, one household, etc. Whereas when we talk about macroeconomics, it deals with actions of the economy as a whole, the country's income, that is the GDP level, the gross domestic product level, all prices, or we can say the inflation rate going on in an economy, the business sector or unemployment across the entire economy. So when we talk about macroeconomics, it is a broader picture of a economy. So let's come back to what is macroeconomics. In this session, we will be going through what is the meaning of macroeconomics, then what is the nature of macroeconomics, the importance, and from where macroeconomics has originated and how faster it is growing. So let's start with what is macroeconomics. Now you know that macroeconomics is all about the study of scope of economics, that is, it is the study of economy as a whole, and basically it tries to answer the following questions, that is, which factors determine the GDP, that is the gross domestic product, and the gross national product of a country. We are going to study that what is GDP and GNP and how do we calculate it in later on sessions. How are GDP and GNP determined? Then which factors determine growth and depression in the economy? It talks about the business cycle. Then what causes employment and how is the aggregate employment determined? Then what causes inflation and deflation and how they affect the economy? Inflation basically is the continuous increase in the prices of major goods and services in the economy, and deflation relates to continuous decrease in the prices of goods and services in the economy. Then how do government policies affect the economy and business activities? So these are the various issues which macroeconomics, which the study of macroeconomics tries to answer. Now coming to the nature of macroeconomics, we say that macroeconomics has both positive and normative policy orientations. Now what does this means? See, when we talk about that macroeconomics is of a nature that it is a positive science as well as normative science. When we talk about positive analysis, it is basically the factual analysis that is based on facts and figures, and it answers the question that what is basically refers to what exactly is. You can very well recognize a positive statement because it can be tested or proven or disproven. There are no personal judgments involved in positive analysis. For example, I can tell you that temperature outside today is 42 degree, and in fact you can verify this statement because you can prove it that whether my statement is true or false. Now when we talk about normative analysis, it is basically opinion based. As compared to the positive analysis, normative analysis is opinion based and it answers the question that what should be. what should be or what ought to be. Now, you can recognize normative statements as well because it involves personal judgments and observations. It cannot be proven or disproven. Suppose, what if I tell you that orange is better than red? Can you verify this statement? Can you test it or prove it? So, macroeconomics is basically a study of both positive and normative signs, and in fact the policies formed by a particular economy is both on the basis of analysis of positive statements as well as normative statements. So this is the nature of macroeconomics. Now see, macroeconomics is very important to study because it tries to provide solutions to these basic problems which is faced by every economy. We start with the first one, that is economic growth. See, you must have heard that a particular country is developing, a particular country is underdeveloped, or it is a developed country. How this is determined that a particular economy is developed or underdeveloped? It is on the basis of a study of the GDP, GNP level of a country. So economic growth, macroeconomics helps to determine that what is the economic growth of an economy, and in fact whether the economy is able to sustain that level of growth or not. It's very important to study macroeconomics to determine this. For example, we can take the data of India. India succeed in achieving a fairly high growth rate, which was of 5.5% during 1980s, and in fact it went up to 8 to 9% in 2003 to 4, but now it is finding very difficult to sustain that growth. So macroeconomics helps to deal in this particular issue. The second basic problem faced by any economy is the unemployment and poverty level. Although the country is developing, or you can say developed, but still it has a level of unemployment and the poverty level. So we say that as and on the unemployment level goes on decreasing, the economy is growing. Similarly, if poverty level is decreasing, the economy is growing. Again, we can take the data of India that there were about 13.10 million persons of the labor force which are still unemployed in the economy. And in fact, 1/4 of the population level in India is still under poverty level. So, macroeconomics also deals with such issues. Similarly, we see that it determines that whether a country, the price level in a country is going up or down, and whether a economy is facing inflation or deflation. See, even if the price level is going up, suppose it's a moderate inflation going on in an economy, but it will basically give a boost to the business sector. They will try to maximize their profits. In fact, they will increase the level of production. But still, if we correlate this to the employment level, we see that there is no change in the employment level. The employment level is not going up. So these relations, these issues are studied by macroeconomics. So now we proceed to have a look at the origin and growth of macroeconomics, and we can see here that the origin and growth of macroeconomics has been divided into three stages, that is pre-Keynesian era, the Keynesian revolution, and the post-Keynesian development. Now let's have a look at all the three separately. We start with the pre-Keynesian era. Now this was the first stage of development of macroeconomics. Now this particular era refers to a period of economic thoughts of classical and pre-classical economists. It was in a time, say 1800s, and the economy at this particular time period was operating at full capacity, full employment, etc. The economists under this particular era basically assume that if market forces of demand and supply are allowed to have free play, that is laissez-faire. Laissez-faire is basically a French term which means that leave alone. The people who support this system basically are against minimum wages, duties, and any other trade restrictions. So it was supposed that there is no government restriction and other restrictions in the economy, and the market prices, the prices of products are solely determined on the basis of demand and supply. And that is where the market is at equilibrium. If there are no intervention and the prices are solely determined by the demand and supply of a particular product, then what will happen? There will be always full employment in the long run. There will be neither overproduction nor underproduction, and the economy will always be in equilibrium in the long run. So this was the assumption of this pre-Keynesian era. Now the basic, you can say the criticism of this theory given by the classical economists was that even if the demand rises, there won't be rise in the supply in order to overcome the demand. So ultimately what will happen? That the prices will increase, that the economy will start facing inflation. See, we get to see a graph like this for the pre-Keynesian era. Supply will be same, and suppose the initial demand curve DD was this, but the demand has now increased to D dash D dash, because this is the equilibrium point where the where the demand curve intersects the supply curve. So initially the price was this, but when the demand raised up, the price also increased, that is, it became P1. So what it led to? It led to inflation in the economy. Now see, when inflation came in the economy, because people were having less purchasing power, so they declined the demand for the goods and services. When the demand of goods and services went down, then the prices also started going down, and it started going down at such a level that it created the Great Depression in 1930. So this particular approach, that is the pre-Keynesian era, the approach by classical economists led to the Great Depression in the economy, which then was solved out by the Keynesian revolution. See, due to the Great Depression in 1930, what happened is the approach given by classical economists basically collapsed, and the economy was actually looking up to a fresh approach. So at that particular time period, Keynes published his general theory, which then again laid down a new foundation of macroeconomics. Now what happened under this particular approach was that the period between the late 1930s and mid 1960s is called the period of Keynesian revolution or the Keynesian era. Now according to Keynes, the level of output and employment in an economy is determined by aggregate demand given the resources. Now I'll show you that what was the assumption of Keynes under this particular approach. See, as opposed to the pre-Keynesian era, that is the approach which is given by classical economists, that supply will remain same whatsoever is the level of demand, what Keynes said was that there are always resources which are unutilized in the economy, and if the demand rises, then those resources can be utilized and the supply can also increase to a level to match the demand level. See, suppose I'm showing it with the help of a graph. On x-axis we take the output and on y-axis we take the prices. Suppose initially the demand was this curve dt. Now the demand raised to d dash d dash. So according to Keynesian era and according to Keynesian approach, the gap between the initial demand and the new demand can be always filled up by utilizing the unutilized resources and by increasing the supply. So according to Keynes, the supply curve used to look like this. That is, whatever is the level of demand, the supply will be the production done will always be able to meet the level of demand. And how did he come to this conclusion? He came up to this conclusion that government intervention is very important, has a very important role in our economy. As compared to the pre-Keynesian era, that is the approach which was given by classical economists, they said that the market should never be intervened by government policies, rules and regulations. But Keynes said that the economy should be regulated by government, and if the government is watching in the economy that the price level is going up or the demand level is going up, it should intervene and take up activities in order to generate more production in order to utilize the unutilized resources of the economy. So we see that in this particular under this particular approach, government has a very important role to play in order to manage the demand for the stable growth of the economy. So we can summarize that this particular approach laid very important emphasis on the government role, and plus it is more towards the demand side of the market rather than to the supply side of the market. Now, after this, the next, what happened is after the Keynesian approach, because the economy is always ever changing and one approach cannot satisfy the changing levels of economy. So again another approach, the third stage came, that is the post-Keynesian development. Now under the post-Keynesian development, more approaches came in order to understand the economic environment. So let's see them. The first one was monetarism. Now see, up till now that in classical economist view and the Keynesian under the Keynesian approach, we have seen that more emphasis is laid on the output, that is the quantity produced. Under this particular approach, that is monetarism, emphasis was much more laid down on the monetary value of the output produced. See, this particular view was given by monetarists, that is monetarism view was given by monetarists. They are a group of economists who are led by Milton Friedman, and the role of money is central to the growth and stability of national output. That is, they are not looking towards the quantity produced, they are actually looking towards the monetary value of the quantity produced. Now see, the monetarists emphasize that money supply, not actually the aggregate demand, is the main determinant of output and inflation. Suppose if the supply of money, suppose if the banks in our economy are giving out the loans easily to the industrial units, then what will happen? The industrial activities will increase, and which will increase the purchasing power, that is level of employment will increase, then it will increase the purchasing power in the hands of consumers, and that will increase the prices of goods and services in the economy. So it will lead to inflation. So that is money supply in the economy plays a very important role in determining the level of economy. Now after this, the next approach was the new classical macroeconomics. Now, this particular approach was given by a group of economists who are known as radicalists, and this was led by Robert Lucius. Now, under this approach, it is assumed that people's expectation about government, monetary, and fiscal policies determine the behavior of aggregate demand and supply curves. Now, what does this mean? This means that suppose if people expect that the next government policy will lead to increase in the prices of consumer goods. So what they will do is they will increase the demand of consumer goods currently, due to which there will be increase in the supply of consumer goods in order to meet the demand. It will actually not influence the output. That is, it is like just a artificial demand and supply created. It will actually not influence the output, but it will change the level of demand and supply. The output will remain same, but it will change the level of demand and supply. So people's expectation is very important to be predicted in order to predict the behavior of a particular economy. The next approach is the supply side economics. Now, as you can see from the name itself, is that this approach lays more emphasis on the supply side, which is contrary to the approaches given by Keynes and the classical economics, who lay more emphasis on the demand side or on the aggregate demand side. So this view was given by Arthur Laffer, and he emphasized supply size of the market. He said that if the tax rates are decreased, then it will give a boost to the businessmen to increase the supply of the product. Suppose the initial supply curve was this, then if there is decrease in the tax rates, it will give a boost to the businessmen to produce more, and the supply curve will shift towards its right and it will become this. So this was the assumption by Arthur Laffer under supply side economics. Now the next approach was the new Keynesianism. See, as you can see that it relates to the Keynesian original approach. It was basically an attempt made in the subsequent years to revive the Keynesian approach. See, whatever approach we are doing, the basic principle of the Keynesian approach is followed by all the approaches, and finally we get to see a new Keynesianism approach. It assumes that information problem and cost of changing prices basically lead to some price rigidities which cause fluctuations in the output and employment level. So this was the new Keynesian approach, and it also laid emphasis that whatsoever happens, government policies and government rules and regulations basically determine the fate of an economy. So now it must be clear from all this discussion that macroeconomics is still in the process of developing. However, what we are going to study later on under macroeconomics, we will be focusing more on the Keynesian approach. That is what assumptions Keynes has taken under his approach. We'll be focusing more on that. In the next session, we'll be starting with the circular flow model of the economy. Till then, have a nice time and thank you for watching Edupedia World.